The theme of our project compares and contrasts renting versus buying a home. At the very least, first-time home buyers need to be aware of all the costs involved that might not be obvious. Buying a home is probably the biggest financial decision one can make in their lifetime, so you need to be aware of those costs and see if, number one, you can afford a home, and number two, do you have the time or talent to upkeep and maintain the home? A home requires a great deal of upkeep and maintenance. Some of the simpler things to consider is mowing the lawn and or removing snow from the driveway. How large is your lawn? How long is your driveway? Are you going to do these required chores yourself or hire someone to do them? Do you have the time to do all the work? When you review the presentation, you will see that you will have to sit down with a pad of paper and or write down not only these costs, but also include all the other possible costs which are determined by the size of the home and the lot it sits on. Even price out the cost to replace or repair a roof. There are huge costs when first purchasing a home, such as all the tools for fixing things. How about a lawnmower, snow thrower, shovels, rakes, power blower, etc.? How about our garden hose that can reach around the house? We also mentioned that in the case of purchasing a townhome or condominium over a single-family home, much of the upkeep and maintenance is absorbed by what's known as HOA, or a homeowners association fee. This fee can amount to a large chunk of change. You have to ask yourself, if I can afford this townhome or condo, can I also afford the association dues, which could start off maybe at $250 a month, but could be as high as $600 a month? Keep in mind that this HOA fee would not include any repair and upkeep for anything inside the townhouse or condo, so those monthly costs will be even higher. The last thing to mention about HOA fees is this: you have no control over how much those fees increase each year. Can you afford an unknown cost increase with these fees? When considering upkeep and maintenance, one must consider where the home and lot are located. When it rains, is there standing water in the yard? If the home has a basement, it will probably have a sump pump. How often does that pump go off? Does it have a battery backup in case of power failure? Now consider a 20-year, 50-year, and 100-year rain. Will your house be completely flooded? You certainly would not want a home where the water does not drain away from the home. Another aspect of renting versus buying is insurance costs. When renting, you insure only for your personal items, not the structure in any way. Insuring just personal items will be much lower in cost. Again, we suggest you read all the material to make an informed choice and decide if renting or owning is right for you.
Taxes. Taxes. So the tax implications of renting versus owning a property can vary depending on various factors: the location, the type of property you're looking to um, purchase or rent, and tax laws in your country and state. So renting and taxes, rent payments. Rent payments are not tax deductible, unlike mortgage interest payments are. You cannot just reduce your taxable income by the amount of rent you pay each year. State and local taxes. Some states and cities impose rental taxes on tenants, which are similar to sales taxes. These taxes are typically a percentage of your monthly rent payment and are used to fund local services. Security deposits. So when you rent a home, you usually are asked to pay a security deposit, which is held by a landlord as collateral against damage or unpaid rent. And then in some cases, the deposit may be taxable as income if it is not returned to you at the end of your lease term. And then there are also moving expenses, and which if you move for a job, you may be able to deduct some of your moving expenses on your tax return, even if you are not a homeowner. These specific rules and limitations around this deduction may impact you, so it's important to consult a tax professional on whether that applies to you or not. Home ownership and taxes. Taxes on homes can come in different forms and can be levied at various levels of government. Here are some types of taxes that may be associated with home ownership. Property taxes. These are taxes levied by local governments on the value of your home and land. The tax amount is usually based on the assessed value of your property and is used to fund local services like schools, police, fire departments. Capital gains tax. When you sell your home for a profit, you may be subject to capital gains tax on the difference between the sale price and the original purchase price. However, if there are certain exemptions and exclusions that may apply, depending on factors such as how long you have owned the home and how much profit you made. Transfer taxes. So some states and localities impose transfer taxes on the sale of real estate. These taxes are based on the sale price of a property and are typically paid by the seller. Estate taxes are if your estate is worth more than a certain amount when you pass away, you may be subject to a federal and or state estate taxes. The value of your home will be included in the calculation of your estate's total value. And then lastly, there are homeowner association fees. If you live in a community that has homeowner association or an HOA usually called, you may be required to pay monthly or annual fees to cover the costs of maintaining common areas and facilities. These fees are not technically taxes, but they are an additional expense that may impact your budget. Taxes continue. So owning a property can offer significant tax advantages such as deducting mortgage, interest, and property taxes while also allowing you to build your equity over time. However, it also comes with additional expenses such as property tax and maintenance costs. Renting can be a good option if you do not want to deal with the responsibilities of property ownership, but it may not offer the same tax benefits as owning a property. Next, we have location. Deciding whether to rent or buy a house is a complex decision that depends on many factors, including your financial situation, your lifestyle, your long-term goals. The location of the property is one of the most important considerations when making this decision. If you're considering renting or buying a property in a location, there are several factors you should probably consider. Affordability, so property prices. In some areas, buying a home may be more affordable than renting due to lower property prices. In other areas, however, renting may be more affordable due to high property prices. Upfront costs may get you. Buying a home usually requires a substantial upfront cost, including a down payment, closing costs, and other fees. Renting, on the other hand, generally requires a security deposit and sometimes the first month's rent. Affordability's monthly costs. The monthly costs associated with renting and buying can vary depending on the factors, including the location. Renting usually involves paying rent and utilities, while buying a home involves a mortgage payment, property taxes, insurance, and maintenance costs. For the long-term costs, over the long term, buying a home can be more affordable than renting, especially if you plan to stay in the same location for many years. This is because mortgage payments can remain stable over time, while rent payments tend to increase. Income stability, the last one. Income stability is also an important factor to consider. If you have a stable income and can afford a down payment and monthly mortgage payments, buying a home may be a better long-term investment. However, if your income is less stable or you prefer more flexibility, renting may be a better option. Flexibility and long-term goals. Renting provides more flexibility than buying a property. If you're not sure how long you want to stay in a particular location or your job requires frequent relocation, renting may be a better option. Long-term goals. If you plan to stay in a location for a long time, buying a house may be a better investment in the long run as it could potentially appreciate in value over time. Amenities. The location of a property can determine the availability of amenities such as schools, parks, restaurants, and shopping centers. Before making a decision, consider if the location offers the amenities you need and want.
Most renters usually have only one payment that they are required to pay out each month to rent their residence. This allows them the ability to budget their expenses easier and avoiding having to deal with the extra payments for things like utilities, maintenance, repairs, and taxes by having them all lumped into one easy to manage payment. If you are renting a home, then usually the renter will be required to pay a security deposit up front to be able to move into their new accommodations. This security deposit is money that is provided up front by the tenant to compensate the landlord for possible future damage or loss. The security deposit can include first month's rent, pet deposits, key deposits, furniture deposits, and last month's rent if it's required by the landlord. Next, we have mortgage down payment. Initially, the purchase of a home is a much more expensive and time intensive process. To purchase a home, the buyer has one of two options. They can pay for the home outright or they can take out a mortgage. A mortgage is a conditional contract of property as security for the repayment of a loan. The mortgage down payment is a partial payment which is made up front at the time of purchase, which the balance to be repaid later. A mortgage down payment can be expensive, however, there are some positives when it comes to paying that large amount up front. It can lower the buyer's debt to income ratio, possibly help them avoid mortgage insurance, and it builds immediate equity. There are different types of mortgages which will have differing requirements to be able to obtain each type. Certain loan types will have different percentage amounts required for each down payment, while others may require a higher credit score. It is here that we have broken down the different types of loans and the requirements to help decide if purchasing a home is within the buyer's financial capabilities. There are three types of loans that are available to potential buyers. Some of these also have their own subsets. A VA loan, which is Veterans Affairs, an FHA loan, which is Federal Housing Administration, and the conventional loan. VA loans are government backed loans which will allow veterans, active duty service members, and eligible surviving spouses to finance a home with no down payment or mortgage insurance. These loan types were created to help veterans access credit and compete in the housing market. VA loans are guaranteed by the government. This assured lenders that even if a borrower defaults, the money that they lent will not be lost. This guarantee comes in the form of a promise to the lender to pay a specific dollar amount to the lender on behalf of each veteran if they default on their loan. There are 5 different VA loan types for the home buyers. They are purchase loan, renovation loan, manufactured home loans, land loans, and construction loans. FHA loans, through the Federal Housing Administration, is a government-backed mortgage that is popular with first-time home buyers and repeat buyers with questionable credit history. This makes this type of loan ideal for potential buyers with a low credit score and or limited savings. There are additional stipulations for a loan of this type. Mortgage insurance is required throughout the length of the loan. There is a higher minimum down payment required. It has higher closing costs than conventional loans, and the home must be the borrower's primary residence. A conventional loan is a mortgage that is not backed by government entities. These loans are likely to be less costly for the borrower. Conventional loans are known to offer some better benefits than other loan types covered. These are a lower required down payment minimum, competitive mortgage insurance rates, the highest loan limits, mortgage insurance not required after 20% of the loan is paid off, and lower closing costs. However, with these benefits comes the more stringent requirements for obtaining them. These requirements are an amalgamation of the borrower's credit score, debt to income ratio, down payment, and borrowing needs. As such, acquiring one of these loans is more difficult to achieve. The borrower's credit score needs to be a minimum of 620 as a base requirement. In addition, the borrower is required to pay a higher deductible than VA and FHA loans by requiring at least a 20% down payment or be subjected to paying mortgage insurance until at least 20% of the mortgage is paid off. Lastly, although a borrower can qualify for a conventional loan while having a 45% debt to income ratio, they will usually be required to pay a higher interest rate and extra fee at closing. There are many different types of conventional loans that can be had. The right loan for each situation is one that will satisfy the lender's requirements and still fall within the borrower's willingness to meet those requirements. The following is a list of 7 types of conventional loans, each with a brief explanation of which scenario they are designed for. Here, we have included a chart to use as a basic reference tool to compare VA, FHA, and conventional home loans to each other, in hopes that these side-by-side comparisons will make it easier to decide which type of loan is right for you. Hopefully, this section has given you some insight into which first step you will need to take when entering the housing market. Is it easier to manage security deposit for a rental the right way for you to go? Or is it worth the extra money to gain the extra independence for home ownership?